Hey folks, it's Dave Burrows. I am Chief Investment Officer and CEO here at Barometer Capital Management. And I want to thank everybody for joining us today. Lots of headlines yesterday. Market's been decent to start the year, but certainly we saw a little volatility on a Monday morning due to some news flow on a Chinese AI model that quickly became the top downloaded app on the Apple Store. And it raised some questions. And so I've asked James Callahan to come on today and talk a little bit about that when we get there. But as always, I want to just take a look at markets, asset classes from a high level, see what's changing, what isn't. As usual, we want to go through kind of leadership themes, what's working, what's not, where we're focusing our attention, some of the ideas that we're focused on. And as always, pictures tell 1,000 words. We're always looking for change and signs that we need to do something different in the portfolio. So let me just jump right in. To start with, we have a picture of the S&P going all the way back to 1900, and we've been working our way higher since 2013. To put it under a microscope, 2013 marked a new high for the S&P, and we've been working our way higher in fits and starts since then. We had a 25% bear market that we went through from December of 2021 through January of 23, and we've been marching our way higher since. So we are now toward the end of January. The S&P is up 3.17%. It is typical for the year to start out reasonably well. First 5 months of the year tend seasonally to be strong, and this year has been no different. When we look at the S&P in the very near term, you can see we made highs back here in December. We had some digestion. We've come back toward the highs, and as of a little earlier this afternoon, we were trading just below highs after a gap down yesterday morning. Now, it was a tough day yesterday for the indices, but under the surface, we think the data tells us a lot. When we looked at the trading yesterday, there were actually more companies making 20-day new highs than new lows. About 345 of the S&P 500 companies were up on the day, but notably, some big ones were sharply lower, and these have been sort of darlings in and around the AI theme, and so they made a mark in the index. When we look at the NASDAQ 100, we had broken down out of this channel. We rallied up underneath it and gapped down on Monday morning. Now you can see we did stabilize through the day, and we moved a little higher today. We're still trading down below this channel. NASDAQ 100 has been a little bit weaker than the S&P, but we'll talk about that as we go along. Outside of the U.S., lots of international markets have been consolidating. I noted last week that the European financials had gone on to make new highs. Industrial companies in a bunch of countries have been doing well. The Nikkei has been consolidating in Japan over the last 9 months now, continues to threaten to break out. We'll see whether it can get going. But this is after the initial move higher out of a very long 33-year bear market. So lots of opportunity, we think, there, as we have seen in some of the Latin American countries and some of the European countries. TSX Composite up on the month of January after a consolidation month in the month of December. Again, you can see we moved up and out of this bear market that ended in 2020. We consolidated like many markets did through 21 and 22 and been working our way higher over the last year. We look at seasonality always just to understand what's possible. It tends to be that January is a pretty strong month, and it has been strong this year. February, March, April, May do tend also to be strong, and you can get a little indigestion over the summer. So we'll watch for that when we get there. We're always watching for signs that we're seeing some change as we stand right now. Things in general have been pretty solid. In fixed income markets, when we look at yields, after a very long period of falling yields and fits and starts, we saw a generational low in 2020. We've been working our way higher and higher highs and higher lows. This is yields on a 10-year Treasury bond. And you can see we're very close to the highs for yields over the last couple of years. This has been really unusual because it tends to be when the Fed starts to cut rates, as they did in September, and other central bankers around the world. I think lots of people thought that bond yields would follow the short-term rates lower. Now, the bond yields are market-driven, and investors have a choice. And it has been, I think, that the market's been building in some term premium or extra return to be paid for tying your money up longer. There are risks of higher inflation. There's risk that maybe growth is a little stronger under a more pro-business U.S. administration. But the net of it is Treasury yields have been tough. So as a result, bond prices have been weak. So this was the peak in U.S. long-term bond prices back in 2020. And it's been really in a bear market ever since. No, bond investors are getting paid their coupon, but when you're losing capital value and offsetting that coupon price, it means that really investors have been getting really absolute negative returns and certainly inflation-adjusted negative returns. So this has been an area that we've been avoiding and continues to look sloppy, not so interesting. If you really have to be in bonds, high yield bonds have been outperforming investment grade. There's a tell in that. It tells us really that since 2020, the economy is printing pretty decent. Bond investors have not been demanding a significant premium yield to put their money in high yield or lower credit bonds than they are in investment grade. And in fact, if we looked at it over time, we are trading at about the narrowest spreads versus Treasury bonds for high yield, going back all the way to 2007. So no hint here that there is any real concern on the behalf of bond investors that credit is not good. So when we look at stocks versus bonds, it's been up and to the right. Stocks have been an outperformer. When we look at dividend growth stocks relative to bonds, for income investors, we think this has been a better solution. We're getting a rising stream of income. And as you can see, we're gaining on a relative basis versus bonds. So total return is the name of the game in income investing. And same when we look at dividend growth stocks as measured by the RDVY ETF versus the high dividend payers ETF, which is made up of more defensive, high yielding securities. Dividend growth has been outperforming pretty steadily. So no change here. That is the makeup of our income portfolio, largely dividend growth stocks. They've continued to perform really well. And that's been one way to offset the impacts of inflation. The other way has been that commodity prices in general have been moving up since that bottom in disinflation. We had the first leg higher. We had the world's central bankers raise rates for a couple of years. And over the last sort of 10 months, commodity prices once again going higher. And I've highlighted the fact that all commodities are not the same. Some of the agricultural commodities have been particularly strong. Things like cocoa have been very, very strong. Coffee's been very strong. But we've seen some metal stronger, aluminum prices, for instance. But this is an asset class that tends to do well when there's a little bit more persistent inflation. And so, when we look at it, commodities are certainly performing better than bonds. So I would say the market is telling us that there's greater risk of inflation than disinflation. Within the commodity complex, probably the strongest commodity has been gold. We've been highlighting this for a while, just been marching higher over the last couple of years. This is after, a very long bear market that it went through. That's the way it works. Right? Get out of a bear market into a bull market, and it can go on for a while. To put it in context, gold went lower from 2012 through 2020. It started to rise in 2024, when we got above the highs from the cup in 2020. It's about 38% above the 200-week moving average. And if we went back and looked what happened the last time we came out of a bear market, each of the first two moves stretched to about 80% above the rising moving average. And so maybe we're halfway there. So things don't repeat, but they rhyme a lot. We want to understand what the possibilities are. After a long period of time, it's an asset that did poorly. I understand why people don't like it, but given the amount of money that's being printed around the world and the amount of deficit spending, there are lots of investors who would prefer to own something like gold as a hedge against the devaluation of their purchasing power. When we look at energy, we highlighted a little while ago that after consolidating through 2024, oil prices, this is measured on a point and figure chart, charged higher, breaking above all these previous highs. Now it's pulled back a little over the last 6 weeks, but that is typical. Very often when you break out, move higher, you can pull back and consolidate. So overall, commodities relative to bonds, if we're looking for a hedge in the portfolio, well, it looks as though investors prefer a hedge against inflation, which would be commodities, as opposed to a hedge against disinflation or falling prices, where you would want to own bonds. Commodities have the edge. When we look at US dollar, and it's important that we look at US dollar has a big impact. Tends to be the dollar strengthens when there's concern and weakens when there's low risk acceptance. Certain assets do better when the US dollar is falling, so we want to understand what the regime is. We highlighted a couple of weeks ago that the US dollar in the run-up to the election became quite overbought. This is a relative strength measure. And when it gets up and out of this band, it tends to be that it's overbought. And if we went back over time to previous periods where it was overbought, well, this was a near-term high. This was a near-term high. This was a near-term high. And even, if we go back into 2023, when it got close to overbought again, local high. So that's kind of important because a weaker US dollar tends to mean global stocks do a little bit better, means that commodities do a little bit better. It tends to mean that US corporations do a little better with their foreign earnings. So it's something to watch. Now, it didn't take long. When Trump was elected for his first term, he very quickly started jawboning about the fact that the dollar was too strong. And then the dollar wound up weakening through the course of the first year of his administration. And over the last 10 days, a couple of times now, discussing the fact that the dollar is too strong and interest rates are too high. And lo and behold, dollar starting to weaken. So it's something that we're watching. It has an impact on leadership in the market and can have some important implications. Just quickly on the way by Bitcoin continues to kind of firm up. If you look at previous rallies, they tended to last anywhere from 6 to 12 months. We're probably 3 months in and plumbing very close to new highs at about $102,000 or $103,000. Bitcoin versus the equally weighted S&P, is firming up. So it's an asset that, you have to kind of take seriously. It is interesting that it's had a number of runs versus the stock market, and it may be that we're close to seeing another one here. Bitcoin versus the aggregate bond index also performing pretty well. So from a big picture perspective, equities really seem to be the asset that we want to focus on most. We want to have some commodity exposure because we're trying to hedge against inflation, some dividend growth exposure to try and hedge against inflation. Nothing changing there. Gold and Bitcoin suggest probably inflation is more likely than disinflation, and nothing changing there. Now, we don't have to be everywhere. Our job is to really identify the key pockets of strength in the market and focus our attention there. We call it market leadership. And that could be sectors within the stock market. It could be asset classes. It could be geographic regions. It could be types of companies, growth companies versus value companies. But we use the tools that we have to try to identify those key themes and focus our attention in those areas. We don't want to be everywhere. Our job is to be a little bit tactical, to recognize change. In the absence of leadership, or where leadership rolls over, be willing to be underweight or be not there at all. Have a willingness to hold cash. So it's a tactical approach that we're trying to bring to the table. We always like to revisit where we stand. The idea is we are trying to identify parts of the market that are healthy. And a healthy part of the market should be constantly attracting new capital. And when you're constantly attracting new capital, buying will start with a leading company and spread to a few more and a few more and a few more. And over the course of a cycle, get to a point where almost everything is headed higher within that sector or theme. That's healthy. There's no bear markets take place when breadth is expanding or the percentage of stocks doing well is getting bigger and bigger. But late in advance, often while the leading stocks keep going well, you get some weakness, and that's something that we watch for. So our top-down work is always aimed at trying to understand which asset classes we should be focused in, which sectors within those asset classes we should be focused in, and target our attention in those areas that are seeing expanding breadth. Now, the bottom-up work, trying to find specific securities, is driven by trying to find securities that are good getting better. There are a lot of people who focus on trying to find companies that are broken, hoping that they'll get fixed. And I won't argue, you can make a lot of money that way, but you can lose a bunch if you get it wrong. We try to identify a combination of about 20 factors that point to companies going through a positive change, acceleration in their income stream, improvement in their balance sheet, price characteristics in the way the stock is behaving that would suggest there's more buyers and sellers. And where we can find all those factors in a few securities, those are the companies we want to focus our attention on. And where we can find companies that meet our tests in areas of the market that are seeing net new buying, showing expanding breadth, well, that's where our portfolio should live. The last piece, and this is an important one, is that this inventory we hold on behalf of our clients, it's amorphous, it's dynamic, it has to change as the world changes. And so the most important job we have is to be really diligent at managing the inventory that we got in client portfolios. So that means we got to know when it's time to mark stuff down and get rid of it and replace it with better inventory. So how do we do that? Well, when we see groups in the market start to see deterioration in breadth, it tells us that the risk levels are rising. It tells us that we should stop putting new money to work. There may be companies that are performing well, but if more and more companies are getting weaker, sooner or later, selling gets to the strongest stocks. So when we see deterioration in breadth within a sector or a theme or a geographic region, it means that we got to be a little more defensive. We got to raise a bit of cash. We got to tighten up the stop losses that we use on all of our positions. And to the extent we get stopped out, look in other areas to put money to work. Don't put money back to work in a weak sector. Okay. So as always, I want to touch on breadth. What's going on now? If you look at this screen, there's a lot of green. The percentage of stocks in uptrends in the NYSE has been expanding, a higher and higher percentage of stocks in higher highs and higher lows. Same globally. In Canada, breadth has been a little weaker over the last couple of months, so we haven't been putting on a lot of new positions. We held cash through December and the early part of January because breadth was not expanding. But about 2 weeks ago, we saw our short-term indicators turn higher first, and then the longer-term indicators start to improve. So really, in Canada, the US, and globally, the percent of stocks trading above their 50-day moving average is moving higher smartly, including what we saw yesterday. Percent of stocks with positive weekly momentum, meaning upward trajectory, is expanding as well. The percentage of stocks making new highs versus those that are hitting new lows, expanding. And the percent of stocks trading above their 150-day moving average or 30-week moving average, moving higher. In other words, the balance of evidence is more and more stocks are performing well. So to put a point on it, about 3 weeks ago, we highlighted that we got to a point where the percent of stocks trading above the 50-day moving average had moved down to 17%. That was very close to the low levels we saw over the previous couple of years before we got a reversal. Since then, the percent of stocks trading above their 10-week or 50-day moving average, 5 days in a week, moved from below 20 up to about 30%, sorry, 50%. And interestingly, yesterday, on a day where the market was down sharply, the percent of stocks trading above the 50-day and on the NYSE was up 2.8%. So more stocks going up than going down. When we look at the percent of stocks with positive weekly momentum, upward trajectory, we hit a low point in December of 18%. We're back just about to 70%. And yesterday, that number was positive. The percent of stocks trading above their 150-day moving average, moving higher since the beginning of January, yesterday up 1.6%. So what does that tell us? It tells us that there were some weak stocks yesterday, but in general, the market absorbed the bad news. In general, the average stock did actually pretty well. And so instead of staring at what the index does, we want to know what's happening underneath the surface. We want to know what's happening across the broad market. So as we look at the sector work in general was up on the week. Percent of stocks in uptrends by sector was up 1.5%. We have the average sector with 41% of stocks in uptrends, and some are better, some are worse. You can see semiconductors went to smaller letters. That means that breadth is contracting. On the other side, precious metals, breadth is expanding, went to large letters. We put them on a bar chart, on a distribution curve. The ones at the right-hand side are the ones with the highest percent of stocks in uptrends. And you can see banks, saving loans, that's regional banks, insurance companies, Wall Street. Financials are broadly positive. Aerospace and machinery, well, that's industrials. Oil and oil service in capital letters in the middle of the pack. Precious metals turning higher. And down at the far end, we can see there's some sectors that are weaker. You know, we see sectors like food and leisure, some consumer-related names, auto. So this helps us to know which groups we should be considering for new positions. Is breadth expanding? Is it moving further to the right? Is a higher percentage of stocks participating? We want to focus in pockets of strength. So let's talk about what's happening under the surface. Now, since 2021, financials have been leading. You can see these are monthly bars, and you can see that as we sit today, we're basically at new all-time highs. Now, when we looked at financials relative to the S&P 500 a couple of weeks ago, it was making new relative highs. And when we look at the stocks, you can see it. JPMorgan, one of our top 10 positions at the firm. This is relative strength versus the stock market. A rising line means it's outperforming. JPMorgan's performed better than 90% of stocks in the S&P 500 over the last 365 days. It's trading at a new relative high. It's trading at a new all-time high. Companies raised a dividend twice over the course of the year. It's just an absolute powerhouse. Goldman Sachs, a great indicator actually for investors' expectations for the markets, because generally they aren't buying Goldman Sachs shares if they think capital markets are going to be difficult. Trading better than 92% of companies in the S&P, trading very close to an absolute new high. In Canada, Royal Bank, probably the most powerful capital markets bank in Canada, seventh biggest bank in the world. Nice rising relative strength consistently. TMX Group, another good tell as to what investors think is going on in the market. Shares of the stock market itself, which participate in the listing fees and the data fees that are sold, when they are relatively outperforming, and TMX Group is representative of virtually all of the major exchange groups, are trading very close to highs. So that's interesting. So financials continue to lead. The XLF is making a new relative strength high. That's the broad-based financials, including the card companies and Berkshire Hathaway, and very close to an all-time high, and almost no impact yesterday on a very weak day. In fact, financials up on the day. Now, I've had some people say, well, financials have been great over the last couple of years. Do you expect this to continue? Now, about a month ago, we put this chart up, and it highlighted the fact that really since the great financial crisis, financials underperformed for an extended period of time. This is the last 2 years. So this can go on a while. They've underperformed a long time. They were in a long bear market. It was a world where regulators wanted to turn financial services companies into utilities. They were so regulated and so hamstrung in the use of their capital. And we are guessing the Trump administration wants to deregulate, which can open up lots of opportunity for these companies. Moving on, the industrials continue to perform pretty well. This is the equally weighted VIS ETF. It's been trading above all of its moving averages, moving nicely higher. It made a low in June of 22. In fact, the market made a low in October of 22. Industrials bottomed before the market did. And it's been really outperforming ever since. Equally weighted industrials versus the S&P are moving up and to the right, continues to be leadership. Howmet Aerospace, a company that had James on to talk about before, but makes fan blades and cast parts, forged parts for the aerospace industry and for the defense industry, continue to perform really, really well. GEV is a company that we've talked about over the last couple of weeks. It had a rough day yesterday. When news that this more efficient model came out, there was some questions as to whether that might change the need for all of this additional power we've been talking about. And virtually all of the companies around power supply had a rough day. Interesting how it came right down to support and held and had a very sharp rally today, up 6%. So we'll see whether that falls through. Maybe I'll get James to talk a little bit about that when we talk about some of the tech. But you can see there was an impact. Now, we started talking about this stock back in here. We've had a really nice run up. We've given back some of those gains, but it has held support. And I think that he's got a pretty positive view. So we'll touch on that in a few minutes. Materials. We talked about materials correcting in the month of December. They did sort of found support here at the rising moving averages. They had a sharply higher week 2 weeks ago. We talked a little bit about that, a 2 sigma move for the group. We have seen some improvement in metals and miners since then, but in particular, we're focused in the gold stocks, the companies that are producing, the companies that are generating cash flow, the ones that are operating effectively. Look at the relative strength in Kinross over the last 2 years, going out basically at a new relative strength high and a new all-time high today. And Agnico Eagle, same thing, new relative high, new all-time high. These stocks are performing really, really well. Under the radar, not lots of people focused on them in a world where everyone wants to talk about tech, but this group is performing really well. On the energy producers, they've been consolidating and we'll see where things go. Our focus has been on more natural gas producers, and we've been focused on some of the long life energy producers. ARC was a company that we talked about a couple of weeks ago. It pulled back into support here yesterday, and Cheniere, like GEV, pulled back into support. But you can see has had a series of higher highs and higher lows, found support here at the moving averages. We'll see how it moves going forward. Still trading better than 90% of companies in the S&P over the last 52 weeks. Also, the pipeline companies continue to be quite strong, a little bit weaker yesterday, but again, nice rising relative strength, nice rising series of higher lows. We think it continues to look very constructive. Okay, consumer discretionary. Just touch on this quickly. This is a group that we talked about a little bit over the last few weeks. We've seen some improvement really since August in consumer discretionary. When we look at what this group is made up of, the big names would be Amazon and Tesla and Home Depot. Amazon being the largest at 20% of this ETF, the XLY, which is a capital cap weighted index. Amazon is just a juggernaut. Relative strength has been charging higher, better than 90% of companies in the S&P. Went out today at a new all-time high, new relative high. This has really been a strong one. We have a small position in Shopify, which has had an excellent day today. I think it was up 7%. And then our positions in Dollarama and Loblaws consolidated over the last couple of weeks. They're a little bit more cautious positions, but they're performing quite well. Let's talk a little bit about communications. This is the XLC ETF. It's the Communications Services ETF. The big weights in here would be Meta, Alphabet, Netflix. And so this is kind of where we're focused. You can see it went out today at a relative strength new high. The percent of stocks making 20-day new highs, sharply higher over the last week. Now 68% of companies in the sector making 20-day new highs. And you can see it. Meta is to report tomorrow and was sharply higher over the course of the last couple of weeks, trading better than 92% of companies. And Netflix, reported about 10 days ago, gapped higher on the report, subscribers numbers higher, and pricing higher. And then there's HubSpot. So maybe I could just get James to jump on for a moment, give us some thoughts on the driving factors in the sector. HubSpot's a newer position for us. Clearly had an excellent day today, up 5.8%. I think we have this across all of our equity mandates. James, you got some thoughts?
Yeah, absolutely, Dave. So HubSpot's a relatively new position for us. As you say, we own it in the equity mandates, and that's probably the only place where it's suitable to own it. They don't pay a dividend. They are a growth software company. And I guess it was either November or December, we were looking out at the tech landscape and seeing some deterioration in the semis. And we were looking for some new tech exposure to add because software was starting to peek its head up. And I know a lot of software ideas were screening in your process, Dave, and in mine as well. And so HubSpot fit the bill for us. It is a mid cap. They're about $40 billion market cap CRM provider. So customer relationship management software provider. They focus on companies that are just too small to be considered for Salesforce and some of the bigger CRM providers to focus on. And so they've grown this really good niche that they've developed. They've added a ton of customers over the years. They've been a really strong grower, and they get their foot in the door to these companies with a great CRM platform. And then they kind of operate a land and expand model. So they will start to sell ancillary software services. They'll start to sell more and more different things inside of the company. Over the last few years, they've started to eat away at larger enterprises. Some of Salesforce's customers have switched over. So they screen really well from a software metric standpoint. Like software companies, you generally look at the net revenue retention, which is a measure of how the business is growing and how they're growing inside of existing customers. HubSpot always screens really well. So it's just been a good software name for us, and for a while has been our only software exposure. So it's worked well.
James, it strikes me that 2025 is going to be a year where investors are going to be looking for implementation of AI strategies to drive revenue. I mean, we've seen this giant build, and the build is continuing for the hyperscalers and building the computing power. But software companies are going to have an opportunity to add products and services and analytics that take advantage of some of the machine learning. And do you think that this is one of the reasons why some of these software companies are performing so well recently? Meta is another company that is hopes to take advantage of some of these revenue opportunities.
You're exactly right, Dave. And these companies, over the last 2 years have been internally building AI systems. And in my observation, I think they're focused in the right areas. Like HubSpot is focused on some chatbots and things to help users with their workflow. They've been building these over the last 2 years. And yes, we are looking for them to start monetizing these things in a more material way, really last year and this year as well. And, we'll talk more about the DeepSeek stuff later on, I guess. But to the extent that running AI models becomes cheaper, it's great for these software names that are going to be using them to drive revenue growth inside of their businesses.
Now Meta is going to report, I think tomorrow, if I'm right.
That's
Uh,
right. Yeah, tomorrow
uh,
after the close.
so what are you watching in the numbers and in the commentary?
So for Meta, I think that we're in the very early stages of their investment in AI coming through in engagement data. And so we see that in time spent on the apps. We see that in monthly active users, daily active users. I've noticed it anecdotally. The Meta products have gotten substantially more addicting, to be honest, because they're showing you what you want to see, and they're doing it in a better way than they ever have. So we're looking for that. I think recently Zuckerberg came out and took up 2025 capex guidance. That would have been something that investors would have looked for tomorrow after the close, but we know that he intends to spend a substantial amount more capex this year building out their AI capabilities than he did previously. So there's a lot that we do know going into this report. So I don't think it's a particularly risky one. But yeah, I mean, we're looking for some evidence that the investment that they've made in AI is coming through to positively influence the user engagement.
Well, certainly investors are voting with their checkbook and buying more shares. It's been a great performer over the last few months. Let's just talk a little bit about tech in general. This is the XLK ETF. So this is made up of sort of the tech super heavyweights. And for those that watch this regularly, they know we don't love to see a relative strength line that has been weakening. We have, people know, been underweight technology for months and months since early last year. And that hasn't changed. You can see this gap lower yesterday where we saw a new relative strength low for the previous 6 or 7 months. So that's something to watch, and it's not a homogenous sector. Certainly, software has been good. Cybersecurity, has been dynamite. Really nice relative strength here at companies like Palo Alto and Fortinet, CrowdStrike. But the semiconductors have been tricky, and maybe just talk a little bit about that. I mean, there have been outliers, but it's not been a leading part of the market. Any thoughts there, James? Just to talk a little bit about this model that was talked about yesterday that drove this sell-off.
Yeah, I'm happy to, Dave. I'll start. And I'll just speak briefly on this, but I'll start from the very basics, just to give an overview of what the announcement was, what the product actually is, and what we're doing about it, because this is something I spent a lot of time on, obviously over the weekend and then yesterday as well. So I guess what's going on, for me, like these types of drawdowns just kind of stress the need for proper portfolio construction. So I think that comes through in our performance on a relative basis recently, and it's good. So we're thankful that we run things properly, we construct the portfolios in a thoughtful manner, and so these big drawdowns, like we saw in themes that we've talked about on these calls and themes that are important to us, it's okay at the end of the day because we construct the portfolios properly. So the what happened, there was a large language model developed by a small Chinese company called DeepSeek. So it's very close to being as good as the flagship model from OpenAI, which is the most prominent large language model developer. So this Chinese company, they developed this large language model in an efficient way. They claim to have done it on a $6 million budget using NVIDIA chips specially made for the Chinese market. I think it's important to mention here that there are credible allegations that this is false. It's alleged that DeepSeek had access to actually about $2 billion worth of cutting edge NVIDIA chips that they hold in Singapore, but the company can't talk about that. It violates US export restrictions. So either way, whether it was $6 million or whether it was $2 billion, the model itself is open source, and they did train it in an efficient way. And from what we know, looking at the AI landscape, they have pushed the ball forward in terms of efficiency of training. So over the weekend, many people got the chance to play around in the model, and very quickly, a narrative took hold that threw a wrench in the theme that we quite like, which is AI infrastructure build out. If this Chinese company can train a model so cheaply, why do the American AI companies need to spend, like we saw the Stargate project announced last week, $500 billion in total over the next 4 years to train theirs? Which I think it's a valid question. And the way that I think about it is that when you look at the way that this Chinese model was trained, they used incredibly high quality pieces of training information that they only were able to get through using the cutting edge American models. And so in this case, they were able to come up with a product that is comparative from a performance standpoint. It does run very efficiently, and credit to them for that. But in terms of who's going to train the next model and who's going to push the ball forward as these companies seek to reach, AGI, it's going to be the American companies still, and we still need these. We still need these big capex dollars to GPUs, and so In terms of some things we're looking for, I know we got a question on that I answered. That I typed the answer to. I'll just mention on that. You know, what we're looking for to see if this narrative does derail this theme from a fundamental standpoint. We're going to look at the cost to rent GPU space in a data center. That'll be a leading indicator to see if these hyperscalers are actually spending less to train these models. So that'll be the leading indicator. We're also going to very closely watch CapEx announcements from the hyperscalers. You know, last week we got some massive CapEx announcements for 2025. If those start to get revised down, that's going to be a big negative for the AI infrastructure exposed names. So for now, I think this was kind of a shot across the bow, but fundamentally nothing has changed for the AI infrastructure names right now. We're going to be watching closely. You know, we've been paying very close attention to this and watching things very closely over the course of the day. And, you know, it's nice to see a name like NVIDIA close on highs today. GE Vernova as well, close on highs today. I think that's pretty positive, but a lot of these names are on the 1 yard line in our process, just to be honest. So we're watching things closely.
Well, you know, look at you know, we're gonna get overnight news from time to time that comes out of the blue and something you deal with. And as you say, you know, constructing the portfolios where we don't have too much concentration in one particular area leading up to it. We've had a underweight, so I feel pretty comfortable about that, and I certainly appreciate you coming on. You know, as it relates to our process, you know, when we look at breadth, this is the percent of stocks in the semiconductor sector that are performing well. You know, we can see that yesterday there was a big impact. So breadth had been improving since December. This shot down means the percent of stocks in uptrends has gone from 50% to 30%. So lots of stocks broke down yesterday. It means that we don't put any new positions on within this sector until that changes. It means that we are tough on the positions that we have and hold them on a tight leash. When there's a break in liquidity, people often say, what happens if something, you know, closes at a high on Friday and opens at a low on Monday? And I often say it doesn't happen very often. But if we get a break in liquidity, in other words, the bid disappears and it drops 15 or 20% overnight, doesn't mean we're going to push it over the edge of a cliff just to get rid of it. We're going to be pragmatic about it. So we did a bunch of work on this yesterday and, you know, got, you know, benefited from the fact that it rallied close to 8% today. So we'll see going forward. You know, it's a sector that has had a difficult time. The percent of stocks trading above the 200-day moving average over the last few weeks has been weakening. And so this is why we haven't been adding new positions. Now, things that are improving, we have seen some improvement, relative improvement in healthcare. It's very early days, although, you know, healthcare sector had a decent day yesterday. Within the healthcare sector, there's a bunch of companies hitting 20-day highs. So that causes us to take a closer look. Breadth has started to improve in some of the sectors. In particular, the one that stands out to us is medical devices. And while the sector was weak, this is made up of companies like Intuitive Surgical and Abbott Labs and Stryker that make, you know, hips and knees. And so we have seen nice absolute improvement and some nice relative improvement. The sector is now trading as well as better than 80% of companies in the S&P. And there could be opportunity here. We are watching. When we think about all the flows into tech over the last sort of 16 months versus the flows out of healthcare, when we get a shift in that relationship, it's something that we take a look at. So we'll take a harder look. There's a few companies that are on our farm team that we think are kind of interesting. Outside of healthcare, the defensive sectors continue to be pretty sloppy. Utilities, you know, have had weaker relative strength since September, weaker breadth. REITs continue to be pretty sloppy. Outside of some, you know, a couple of sharper rallies, relative strength for consumer staples has been uninspiring, and concern around the impact of GLP-1 drugs on consumers' buying habits, you know, is certainly an issue. And you know, we always watch for shifts, and we think that there's some great companies in technology, and we have a few targeted ones. But on the other side, we think that there's other things to do too, and just interesting to see gold relative to semiconductors making a turn positive for the first time since 2012. And so we think, again, that could be an early days theme. So what it all means is that there's not tons of change in the portfolios. We tend to focus on the strength. So financials are now 35% of firm assets. We love to see a sector get stress tested on a down day and wind up against a weak market. Energy is a significant overweight at 18%. A lot of that is energy infrastructure. Industrials are still an overweight at 12.5%. Technology still, basically 1/3 of the weight in the S&P. That certainly helped yesterday. Communication services has come up over the last few months, close to 10% of firm assets. That's those companies like Netflix and Google and HubSpot. Materials are about a triple weight. That's almost entirely precious metals producers. And then we have very light weights in healthcare, real estate, utilities, and consumer discretionary, consumer staples. So we just want to keep in mind that the number one thing that drives asset prices is liquidity. And while we may not get a lot of rate cuts this year, in the cards is probably 2. Other countries are also cutting rates, and that provides liquidity, and that drives asset prices. We watch every day for signs of risk. Credit risk, is basically hitting near-term lows. If I see what happens when you get concerned, through 2022 bear market, the credit spreads widened. Through the sell-off and COVID leading into the early part of 2020, a big expansion in credit spreads, an expansion in credit spreads in 2015, 16. Certainly there was one in 2008 that was like we're looking at Mount Everest, but there's no sign of that at this point. Volatility is relatively low. We're right in the middle of the range that we tend to be in during cyclical or structural bull markets. So nothing to be concerned about there. And when we go back to the big picture, when you get out of these bear markets, you tend to get anywhere from 2 to 5 years before you get any meaningful correction. Historically, when you got 2 years into a bull market without a meaningful correction, the bull market lasted on average 5.5 years. So, we're about 2 years in. And we think that there's about 1 year in. We think there's lots of opportunity for this to continue. And so, we're going to continue to be positioned so long as the breadth model suggests that it's the thing to do. And as long as our stops don't get hit. When we think about it in time, this is about the length of the bull market we've seen first 2 years from the lows in October of 22. They can go on a long time. Things get more difficult, we'll get more defensive. That's what we do. We use our stops. We're not afraid to hold cash. But as we sit right now, I think that probably positioning makes sense. So with that, let me take a look and see if there's any questions. Looks like there's a couple. See what we've got. Oh. Lawrence, did we get stopped out of any positions yesterday? So Lawrence, as I mentioned a few minutes ago, that it's a great question. The one thing that we're very careful about is when we get a break in liquidity or when there's a major market break overnight, the last thing you want to do is just push a bunch of things out over the edge of a cliff because the bids go away for a while. Stop losses are most commonly used as prices start to fall, they hit your stop level and you move away. But when you get a large gap from a Friday to a Monday morning, the first thing you don't do is push something out over the edge of a cliff. Now, of course, we monitored through the day. We did a bunch of work on each underlying position. There were 3 that we came very close on: GEV, which we've been talking about, NVIDIA, and Broadcom. The assessment that we had was that we wanted to see another day of trading. We had big rallies in all of those companies today. The fundamental picture continues to look pretty good. If we were to breach the lows from yesterday, we'd be gone. If we saw more breadth deterioration in the NASDAQ, for instance, you'd see us gone. But this is where, experience comes in. And to be honest, investing is a little bit of an art along with a science, and you've got to be pragmatic. Alejandro, what is our view on CNQ, and do we think it's a good point to start a position? So based on what we talked about with energy, oil prices are operating on a point and figure buy signal, structurally firm. They did pull back a little over the course of this month, correcting, but there's nothing that changes the trend. The long-term picture for CNQ, we think, is very positive. It has pulled back some, and it is not far above where we would stop ourselves out. In the meantime, we're getting paid a great dividend, and the dividend growth is solid. I think some of the recent weakness has to do with, concerns around tariffs, and that's a logical thing to think about. But we think it probably is not a bad entry point. You can see that breadth in our models we talked earlier, breadth for both oil and oil service is positive. So we're comfortable being a buyer here and being a holder. Comment on copper. So John, I don't have the chart here in front of me now, but you'll recall over the last month or so, we said, look, copper came right down to the long-term moving average in the month of December. We said this is a place that we have to see it hold. It did hold and rally nicely 3 weeks ago. It's consolidated over the last 2 weeks. As it sits right now, I think that there's going to be a lot of money spent, and copper is going to be in short supply. So at this point, we're comfortable with materials. We're trading above the moving averages. There's some work to do, obviously, but we think the risk reward is pretty good there. Do you think that, Jerry has asked, do you think the Trump administration will try to effectively repeal the Dodd-Frank Act? As quoted from the Obama White House, Dodd-Frank will prevent the excessive risk-taking that led to the financial crisis. Jerry, I think about regulation as a giant pendulum. When we headed into the financial crisis in 2008, clearly, deregulation had gone too far. Deregulation started in the early 80s with Ronald Reagan and went on over the course of almost 30 years to the point where, big financial services companies were taking excessive risks. To put a point on it, they were getting 40-to-1 leverage. So for every dollar of capital the banks had, they were leveraging it up 40 times. If you look at it today, it's more like 9 times. So regulation swung from all the way in one side to all the way the other, where we wound up with overregulation. Multiple bodies regulating the same institutions, many different ways, the reporting requirements onerous and complicated, making it very difficult for all but the biggest to be public companies. And we just think that there is opportunity for streamlining of regulation to create opportunity for, smart mergers and acquisitions, for capital markets opportunities. And, I think at some point, maybe the pendulum will swing back too far to the other side. But at this point, the number of regulations that were added under the Obama administration and under the Biden administration are off the charts. And it made it very hard to get a return on capital as a financial services company. So I think maybe just some moderation is going to be helpful, and that's one of the things that we're counting on. I think that is it. It is. Okay, well, listen, I hope it was useful. No fun looking at the market yesterday, for sure. But very quickly, we could see that really it was very compartmentalized after the initial, sort of 20 minutes of trading. I was really pleased to see the breadth data through the day yesterday, and some nice follow through in some of the leadership today. So we'll be back next Tuesday. We'll maybe know a little bit more. If you've got some questions in the meantime, don't hesitate to reach out to us. Certainly happy to answer any questions that you might have. And we'll see you next week. Thanks, folks.